Hi, I'm Rick Kaler. Thanks for joining me. A recent post on Twitter asked, why don't more financial planners advise their clients to pay down debt? Well, that's a good question. Certainly many advisors do. The reasons others don't might lie in the type of debt, the age of the client, the advisor's investment philosophy, and the advisor's compensation model. Let's take a look at each of these. While most advisors would agree that paying off short-term debt with high interest rates like credit cards is a top priority, all debt isn't bad. Debt can be a useful tool for building wealth through buying, say, like real estate or other income-producing property. Nor would many advisors recommend paying off a long-term fixed-rate home loan with a low interest rate until you've built up some savings. This would include saving for intermittent expenses like car repairs, home maintenance, vacations, medical bills, Christmas, as well as a reserve fund for true emergencies. All these I just listed aren't emergencies. They're one-time expenses that we know we will have sooner or later. But then a reserve fund for true emergencies, such as, say, a job loss. Now, once we have those two savings accounts set up, and especially if you're young or in a high tax bracket, the wisest move may be to put your extra cash toward fully funding your retirement. A good rule of thumb is saving 20 to 50% of your take-home pay toward retirement. Yeah, that sounds high, but consider that the average American is woefully underfunded for their retirement. Now, the first place to put these funds is in a retirement plan like a Roth IRA, Roth 401k, profit sharing plan, or some type of ERISA plan, a defined benefit plan. There's a lot of plans to choose from. Some advisors will incorporate debt into their investment philosophy by encouraging clients to borrow on the margin. Now, this is a way to double the value of the stocks in a portfolio by borrowing 50% of their value. So, for example, you can control $100,000 of stocks with $50,000 down, and the broker loans you the other $50,000. It gives you the potential to supercharge your gain and supercharge your losses. It's not something I recommend, but some advisors and their clients like to live on the edge. Another reason advisors may not recommend paying down debt is more self-serving. In some cases, reducing a client's debt also reduces the advisor's paycheck. Let me give you an example. If an advisor is primarily compensated by commissions, any capital that flows into reducing debt will mean less money flowing into financial products that pay commissions. Commissions on mutual funds, annuities, and insurance products range from 1 to 10%. So if an advisor has the option of advising you to pay your home mortgage down by $100,000 or use that money to buy a variable annuity with a 10% commission, which choice does the advisor have more incentive to recommend? Now, very few advisors who would recommend the annuity will tell you the real reason is so that they get a bigger paycheck. The same is true for investment advisors and financial planners that charge a flat percentage on the assets you give them to manage. Why, they'll be earning a commission, so to speak, on the assets under management, even though they don't earn a specific commission. They typically earn 1 to 2% annually on the assets, typically billed quarterly. The dollar amount in the portfolio declines because a client sells assets to pay off debt, their fees will decline accordingly. Now, certainly, I want you to hear this, especially if you want a commission advisor. There's advisors who are using both these compensation models who will recommend that you pay down the debt even though it means they're going to lose income. But they're in the minority. Typically, these are fiduciary advisors that will tell you this, who are regulated by the SEC, by the Investment Act of 1940, who have a legal obligation to put your interest ahead of theirs. But there's very few of those types of advisors out there. The safest way that I know of to know that your advisor is truly looking out for you is to select one that is fee only, who charges based on an hourly rate, a flat rate, or your net worth. Under those compensation models, using funds to reduce debt has no impact whatsoever on their fee. Whether and how to pay down debt is certainly an important aspect of financial health. Any reputable financial advisor should be committed to helping you manage debt wisely as a part of your overall financial plan. Thanks for joining me.